Silver has surpassed the $100 per ounce mark. If one looks only at the price chart, it is difficult not to see this as a sign of a strong market. High prices, strong demand, and capital seemingly flowing into precious metals. In many previous cycles, such a reaction would have been entirely reasonable. This time, however, when observing the market at the ground level, where transactions take place every day, the picture does not fully align with what is shown on the charts. At many physical metal shops, a rarely discussed phenomenon is emerging. Coin shops are refusing to buy silver, in some cases refusing to buy at any price. Some shops are closing earlier in the day not because of a lack of customers, but because they have exhausted their ability to finance purchases. Others continue to post prices higher than their competitors, yet no longer have sufficient cash on hand to keep trading. These details do not appear on price boards, nor do they show up in official reports, but they clearly reflect how the market is reacting. What is notable is that demand has not disappeared. Buyers are still there. Sellers are still showing up. However, based on what can be observed, transactions are slowing down or taking place only within a very narrow range, where the parties involved still have sufficient confidence in cash flow and settlement timing. Here, an important paradox emerges. When prices rise sharply but the market is reluctant to trade, the issue is not the price itself. This is often difficult to detect when looking only at numbers, but it becomes clearer when observing the behavior of shops and how they make buy and sell decisions. At moments like this, the market is sending a different signal, quieter, harder to quantify, but far more meaningful. It is a signal of tightening liquidity, rising settlement risk, and a mechanism behind prices that is beginning to operate less smoothly than before. In other words, this is not a story about silver being expensive or cheap. From the perspective of a market observer, this is a story about how the system behind silver prices is changing, and such changes are usually recognized first at the level of real, on-the-ground trading. To understand why this is happening, it is necessary to set the charts aside for a moment and look more deeply at how the physical metals market actually operates, where cash flows are circulated, where risk is allocated, and where the first signs of stress begin to appear. And before we move into a deeper analysis, don't forget to subscribe to the channel to stay updated with the earliest information on gold and silver in this highly volatile market. On the surface, the silver and gold markets still appear to be operating normally. Shops remain open, price boards are still being updated, and every day there are people coming to buy, sell, or exchange metals. If one only glances briefly, it is very difficult to notice anything unusual. But when observing more closely, not for a single day, but repeatedly over many days, certain signs begin to appear with enough frequency that they can no longer be ignored. These signs do not always occur simultaneously, nor do all shops react in the same way, but behavioral patterns are gradually beginning to overlap. First is the level of price volatility. Silver has not only surpassed the $100 per ounce mark, but has also been fluctuating with very wide intraday ranges. At certain moments, prices have moved up or down by $15 to $17 within just a few hours. In such an environment, maintaining a fixed posted price becomes a risk that most shops are no longer willing to accept. This is why many coin shops have been forced to shift from unit-based posted pricing to a spot plus premium model. Based on what can be observed, this change is not aimed at maximizing profits, but at reducing risk when prices move too quickly. When prices can diverge within minutes, holding a fixed price is no longer practical. Another sign, less frequently discussed, is the increasingly thin state of display cases. Despite high prices and continued demand, the amount of silver and gold on display in many shops is disproportionately low. On some days, shops buy large volumes but are unable to sell at a corresponding pace. On other days, they manage to sell but hesitate to buy more to replenish inventory. More strikingly, situations that were previously rare have begun to emerge. Some shops post buy prices several dollars per ounce higher than competitors, yet still have to close early in the day because they run out of cash. Decisions like this are not made lightly, as closing early means turning away customers and sacrificing long-term relationships. However, in the current environment, such actions represent a defensive choice. All of these phenomena, if viewed individually, could be dismissed as minor irregularities in a volatile market. But when placed side by side, they form a fairly consistent picture. The market remains open, but its capacity to absorb risk and rotate capital is deteriorating. In other words, transactions are still taking place, but only within a range where the parties involved retain sufficient confidence in cash flow and settlement timing. Any transaction that falls outside that range is delayed or rejected. This is not a sign of collapse, but a sign of caution spreading through the system. And it is precisely from these on-the-ground observations that an important question begins to take shape. What is causing shops to become so cautious? The answer does not lie in demand or prices, but in a less visible link in the chain, where the real tensions are quietly accumulating. To understand why the phenomena described in the previous section are becoming increasingly evident, it is necessary to look at a link that normally receives very little attention: refiners. This is not a topic that typically appears in headlines or price boards, yet it is where the smooth functioning of the physical metals market is ultimately determined. For many years, refiners have acted as a liquidity shock absorber for the entire physical metals market. From the perspective of coin shops, this mechanism has been so familiar as to seem almost self-evident. Buy metal from the public, send excess inventory to a refiner, lock in the price at spot, and receive payment the same day or within just a few hours. As a result, price volatility risk was contained and cash flow was kept in constant circulation. This very mechanism enabled many small shops to survive and grow. Even with limited capital, they could continue operating thanks to rapid cash turnover. For a long time, few questioned the role of refiners, because the system functioned smoothly enough that there seemed to be no need for further scrutiny. In the current environment, however, what is being reflected from the market suggests that this familiar mechanism is no longer operating as it once did. Some major refiners have stopped buying silver altogether. Those that continue to purchase have changed their terms in a more cautious direction. Prices are no longer locked in at the time of receipt, and payment periods have been extended. It is worth noting that these changes are rarely announced publicly. They do not appear in press releases or on websites. Instead, they are communicated through emails, phone calls, or small clauses within transactions, details that only those directly involved can clearly perceive. The most significant consequence is not merely delayed payment, but uncertainty over the settlement price itself. When pricing is determined only after the refining process is completed, shops no longer know with certainty how much they will be paid, while the market may fluctuate sharply during the waiting period. The entire price risk, previously absorbed by refiners, is now being pushed back onto dealers. From a business operator's perspective, this represents a fundamental shift. Cash flow not only slows down, but also becomes far less predictable. And when cash flow is no longer certain, every decision to buy must be reconsidered. This is not an emotional reaction, but a defensive response to time risk and counterparty risk. In other words, refiners are no longer fully performing their role as shock absorbers. As this shock-absorbing function weakens, shocks from price volatility and settlement delays are transmitted directly to the front layers of the market. This is not a minor technical malfunction, but a sign of liquidity stress at the foundational level. And once such stress emerges, the changes in behavior observed at the micro level among shops, as previously described, are no longer difficult to understand, but instead become the inevitable consequence of a mechanism that is now operating differently. As the risk-absorbing role of refiners weakens, the first effects do not appear on price charts, but rather in the very ordinary decisions made by shops. This is where the market reacts most quickly, because decisions to buy or not to buy are now directly tied to the ability to maintain daily cash flow. One noticeable change is that purchasing criteria have become much narrower. Based on what can be observed, many coin shops now only buy products that they know with certainty can be resold the same day or within a very short period. Popular bullion products that customers are familiar with are still accepted. By contrast, types of silver or gold that were previously accumulated for refining are increasingly being viewed as risky. This is not a minor adjustment. For many shops, refusing to buy scrap silver or non-bullion material is a difficult decision, as it means saying no to customers with whom they may have traded for many years. However, in an environment where cash flow is no longer certain, such decisions become a form of self-protection. Another factor that is gradually becoming evident is the time pressure placed on capital. Under normal conditions, waiting a few days for payment is not a major issue. But when markets are highly volatile, Each day of waiting carries both price risk and liquidity risk. For shops with thin capital buffers, even a single large gold transaction can cause cash to become trapped for several days, something they can hardly afford to accept. For this reason, there have been days when shops purchase only very limited quantities, or even stop buying altogether. From the outside, this may appear to be a sudden freeze, but from the perspective of shop operators, it is the result of a very practical calculation. Continuing to buy means accepting time-related risks that they cannot control. An important point to emphasize is that businesses do not make these decisions mechanically. Each decision is accompanied by hesitation, because stopping purchases affects not only current revenue, but also long-term customer relationships. However, when faced with a choice between the risk of losing customers and the risk of losing the ability to meet payments, many shops are forced to choose the less dangerous option. When these defensive reactions occur simultaneously in many places, they create a chain reaction. Trading declines, inventories are constrained, liquidity tightens, and pressure continues to shift toward the shops that remain active. This process is not loud or dramatic, but it is sufficient to change how the market operates in practice. At the micro level, this is how a liquidity shock spreads, not through an immediate collapse, but through a series of cautious decisions made by individuals who are trying to keep their businesses alive day by day. As the market enters a phase of liquidity stress, differences between business models begin to stand out very clearly. Practices that had operated smoothly for many years no longer guarantee effectiveness when cash flows are stretched and settlement risk increases. This is the moment when the internal structure of each shop is examined without leniency. The models most heavily affected are those shops that focus almost exclusively on bullion. Under normal conditions, this is a simple and efficient model. Buy quickly, sell quickly, send excess inventory to refiners, and rotate capital continuously. For many years, there was little reason to question the sustainability of this approach, as it enabled numerous shops to survive and grow steadily. In the current environment, however, based on what can be observed, that very dependence has become a weakness. When refiners no longer guarantee price locking and rapid settlement, the bullion-only model loses its operational foundation. With thin capital buffers and cash flow dependent on immediate settlement, just a few days of delay can be enough to bring operations to a standstill. This is not a matter of managerial competence, but rather a change in market conditions that renders the old model no longer suitable. By contrast, shops with more diversified business structures appear more flexible during this period. These shops do not rely solely on silver and gold bullion, but also trade collectible coins, ancient coins, paper currency, watches, jewelry, or diamonds. That diversification allows them to sell directly to end customers and generate cash flow without always having to go through refiners. An important point to emphasize is this: no business model is absolutely right or wrong. In this industry, many models have operated effectively for years under different conditions. But when the liquidity environment changes, the ability to disperse risk and maintain cash flow becomes decisive. Shops with multiple revenue streams often have more time to adapt, while those dependent on a single link in the chain face immediate pressure. From a human perspective, pivoting is not easy. Diversifying operations requires knowledge, time, and sometimes stepping outside a comfort zone that has been familiar for many years. Nevertheless, based on what is unfolding, many shops are being forced to reconsider how they operate, not in search of higher profits, but to reduce their dependence on settlement mechanisms that are now under strain. In periods like this, the market does not reward rigidity. It rewards adaptability. And it is precisely differences in business structure, more than getting price forecasts right or wrong, that are determining which shops can continue operating and which are forced to scale back. When placing what is currently unfolding into a broader picture, there is one point that must be made clear from the outset. This does not resemble a typical price-driven bull cycle. If one looks only at prices, it is easy to conclude that the market appears healthy. But when observing how transactions are actually executed or delayed, the story becomes far more complex. In financial and commodity markets, prices are often a lagging indicator. Before stress appears on charts, changes in liquidity, settlement, and counterparty behavior usually occur behind the scenes. Based on what can be observed at present, the physical metals market is following that familiar pattern. liquidity is tightening while prices remain elevated. This does not mean that demand has disappeared. In fact, buyers and sellers are still present. The issue is that participants are becoming increasingly cautious about time risk. When there is no longer certainty about when cash will return or at what price, transaction decisions are forced to change. This is a natural human response to uncertainty, not a sign of panic. From a monetary perspective, what is unfolding reflects funding pressure within the system. As the cost of risk rises, each link in the transaction chain seeks to retain liquidity for itself. This process does not require a major shock to be triggered. It unfolds gradually through a series of small, defensive decisions. And it is precisely these small decisions, when aggregated, that generate a large impact on the circulation of assets. One notable feature is the growing divergence between price and liquidity. Prices may continue to reflect long-term expectations, hedging demand, or market sentiment. But the ability to convert physical assets into cash, an essential factor in day-to-day business operations, is constrained by settlement conditions. When these two elements no longer move together, the market enters an unstable state. In previous cycles, similar signs often appeared well before the market recognized that conditions had changed. This does not mean that history will repeat itself in the same way, but the pattern of liquidity tightening ahead of price adjustment has been observed many times. Identifying this pattern requires looking beyond charts and accepting that not all important signals can be measured immediately. At present, the physical metals market is undergoing such a test. This is not a test of confidence in the value of silver or gold, but a test of the functioning of settlement and financing mechanisms. And the outcome of this test, although not yet visible, will shape how the market operates in the next phase. What is unfolding in the physical metals market makes one thing quite clear. This story does not end with silver surpassing the $100 mark. Price is only the most visible layer of a much deeper process, in which liquidity, settlement timing, and financing structures are beginning to play a decisive role. At this point, it would be premature to draw definitive conclusions. The market is still in motion, and many variables may change over time. However, from an observer's perspective, it is evident that the changes now emerging are not random, nor are they confined to just a handful of shops or a few isolated transactions. If refiners continue to maintain a cautious stance, extending settlement periods and limiting purchases, the key question will no longer be how much silver or gold will rise or fall. The real question will be, who still has the capacity to continue operating in an environment where cash flow no longer circulates as it once did? And when the old models no longer function smoothly, in which direction will the structure of the physical metals market evolve? These questions do not yet have clear answers. And perhaps at this stage, attempting to reach firm conclusions is less important than continuing to observe how the system responds. In many previous cycles, it was precisely the quiet signals in the background, where liquidity was being squeezed and risk was being shifted, that foreshadowed major changes long before they appeared on price charts. If you are interested in stories like this, not just about prices, but about how financial systems and markets actually function, please subscribe to the channel. The content on this channel focuses on observing and analyzing the subtle shifts within markets to understand what is breaking before it becomes obvious to the majority.